Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. In this edition of the podcast, I shall be talking to two of our guests about the dramatic intervention by Saba Capital into the affairs of UK-listed investment trusts. First, I shall be speaking to Karen Brade, the chair of Keystone Positive Change, a Baillie Gifford managed trust, which has been one of 7 trusts which have been requisitioned to hold general meetings, at which Saba Capital will propose removing the entire board and substituting 2 directors, one an employee of Saba and the second nominated by them. Secondly, I'll be talking about this development, which affects, as I said, 6 other trusts have also been requisitioned, and Saba holds significant shareholdings in up to nearly 20 trusts overall. I should be talking about that to Ben Conway, who is the head of fund management at Hawksmoor Investment Management, who has some interesting perspective as a professional investor in investment trusts about what Saba Capital is proposing to do. There will be a series of these votes in late January, early February, at which the Saba resolutions will be considered and will pass if 50% of those shareholders who opt to vote in favour. Now, in the case of Keystone Positive Change, Saba has a effective holding of 29.2%, at least that's according to the more recent disclosure announcements, although its direct holding is believed to be only 5.7% and the rest is held through derivative arrangements. In the case of Keystone Positive Change, the board there has already put forward a proposal to offer shareholders a full exit at close to NAV after a period of disappointing performance. The board there moved the mandate to Baillie Gifford in February 2021 and adopted what's called an impact investing strategy designed to invest in companies that have a measurable beneficial effect on the world, either in social, economic, or environmental terms. I began the first segment of this podcast ever by asking Karen Brade when she first became aware of Saba's involvement in the trust and how the dialogue with this US activist investor has developed since then.
So to give you the background on our relationship with Saba, I first became aware of them on the register probably the fourth quarter 23. And at the time they were up around, I think, about 10% shareholding. So significant. And there was some concern as to what their objectives were. You know, I had experience with what you call the discount players, you know, the 1607s and the Old Springs of the world and even City of London. And so I sort of feel that they have a role to play. You can have a dialogue with them and they come and they go depending on performance and the movement of the discount. So I contacted Saba to introduce myself and to understand what their game plan was. And I said the same thing to them. I said, you know, I'd rather you weren't on the register, but I recognize you are here. Let's discuss what I have to do to get rid of you, because that's really what I would like to do, is not have you on my register, because you're not the type of investor I necessarily want. And he was very nice about it. And we chatted away and we talked about the performance and the discount and all the challenges that we as a trust and also the sector-wide challenges that we were facing. And I explained that we were planning to put some measures in place and would he come to the AGM? It was early February 24. And his response, this was Paul Kazan, who's based in New York. His response was possibly, but we'll be in town in London that week, but not sure. Anyway, he didn't show up at the AGM in February, which is just a year ago. We put forward a continuation vote because, I always try my best to consult widely with shareholders. And invariably, they don't always want to speak to the chair. They usually will speak to the fund managers. But between the two of us, we figured out that the patience was extremely high and the tolerance to the performance was very, very high. But a continuation vote would be very much welcomed. And so that's what we decided to put in place, to allow the strategy to play out over 5 years. And the other thing we announced was a buyback program. And I think the announcements were both very well received. The AGM went very smoothly. I had no difficulty with Saba at that meeting at all. And in fact, they weren't even there.
Did they actually vote in that?
I'm rather embarrassed to say I don't think they did, but I'm not sure. That sounds awful, doesn't it? I mean, the fear was they were going to be more aggressive and put in requisition resolutions and all that type of thing. And they just didn't. They completely were absent. So I have a feeling they didn't vote. And actually the turnout is 20%, which is pretty typical, as you know, in these investment trust boards. We tend to get very low turnout when it comes to voting. And virtually nobody comes to the AGM, so it's always difficult to ascertain.
Just to be clear, the decision to hold a continuation vote or to offer a continuation vote was not specifically driven by Saba appearing on the register.
No, because it was already been discussed before I even realized they were there. It was obvious that we had moved our trust to this new strategy in February 21. When we announced the decision to move to the strategy the previous year, which is the end of 2020, our discount came right in. The market reacted extremely well to it. My register rotated away from the discount guys and the retail piled in. It was really well received. And then, unfortunately, having gone through the approval process in February with our shareholders, we transferred the week before the crash. And the rotation away from growth was pretty dramatic, and it was just horrible timing. The performance was really challenging. So in recognition of that, we knew we needed to put something in place. Although many of the shareholders I spoke to understood and they were patient. But still, there were others who said, you need to do something to reassure us. So the continuation vote was one of the obvious solutions. And so that's what we announced in February last year. And combined with the buyback. I felt it was pretty punchy. We bought back 5% of our capital last year. So in doing the buyback, obviously I'm shrinking, was already a small company. And I watched Saba build their stake. And by the summer, last summer, he was up to 20%. So I contacted him and I said, look, I'm buying back shares, shrinking the company size, but you're mopping up a lot of my liquidity. And liquidity is a real challenge in small companies. And my other investors don't like seeing very poor liquidity. And you're kind of part of the problem in that sense. So can we discuss it? And definitely his view had hardened in that 6-month period or a 9-month period. And he said, I want cash out and I'd like cash out by first quarter 25. And I responded by saying, it's not that easy. I mean, I hear what you're saying, but it isn't that easy. For one, I've got some private companies in the portfolio. And his instant reaction was, oh, Bailey Gifford can buy those off you. That's no problem. And I said, no, it doesn't work that way. In this part of the world, in London, we have consumer duty rules. We have to do things properly. We have to follow due process. And you can't just assume I can just sell a portfolio overnight without destroying value, significant value, I would imagine. But I will go away and figure out a solution. Thank you for your time and let me go and consult more widely, which is what we did. And I worked with my fund managers. Katie Fox spoke to most of our investors because generally they'd rather talk to the people managing the money than the chairs, as I'm sure you're well aware. So we really did consult very widely. And what was interesting was the feedback we got was we actually really like the strategy. We're still feeling quite patient, performance issues aside. But we recognise with the company size and with the liquidity and really with the discount where it is and with the level of shares that Saba's now holding, a cash exit is probably the right answer. And other shareholders were very clear that they wanted to remain with the strategy or something close to it. So we came up with a scheme, which we announced in September, which was to give people an uncapped cash exit at 1% to NAV. And for those who wanted to remain in the strategy, they could roll over into the sister fund, which is Bailey Gifford Positive Change. And the market response was phenomenal. I mean, the moment we announced that, the discount came right in to reflect that structure. We had a message via my advisors that Saba said, we like the direction of travel, we just want to see more detail. So we then went away to work on the detail, which we finally announced it in early December. So in that period, interim period between announcing in early September and actually publishing the scheme in early December, we reached out on a number of occasions to Saba. And the first time, I think, was probably in early October. The advisor spoke to them and said, you said you wanted more detail. Can we help you? And it was with Paul, and he really wanted to ask a lot of questions about the private companies. And it was clear he needed a lot of explanation. And because he wasn't inside, you can't discuss anything that's not in the public domain. But he couldn't really grasp a lot of that detail. So with patience and time, there was a lot of explanation given on the private companies and the challenges and the issues and how it works. And then we continued with preparing the scheme and we reached out a second time, and maybe I think the advisors might have gone another 2 times. And the other 2 times they said, no, thank you, we don't want to talk. And then just before the scheme was due to be announced, I felt really I needed to reach out to them directly to see if it was just because the advisors were doing it and, maybe if I did it, it would be easier. I emailed Paul and I got a response from Michael D'Angelo, who's their head of legal, saying, no, thank you, we don't want to be inside, even though the scheme was being published the next day. It was kind of frustrating because the whole thing was initiated around their decision that really they wanted to see a cash exit in the first quarter 25.
So you felt you actually delivered that option to them?
Well, that's what I was trying to deliver in spades, yes. So anyway, we went ahead and we published, and again, very, very good feedback from the market. The wealth managers were very positive. Not a single criticism, I can say. Honestly, it was really kind of reassuring. And I asked over and over, have we heard from Saba? I didn't reach directly to them, I have to be honest. I felt that's what the advisor there for, but no, there was no response. And they said, it's good news, probably. I'm sure it's fine. And of course,
So
it
that's
was.
what Saba related via the advisors.
No, they just didn't engage.
Oh, they didn't engage. Okay.
But I certainly didn't contact them. After the scheme was published, I didn't contact them personally, but they didn't reach out. They didn't make a comment.
Were they still buying shares at that stage?
I don't think so. They were pretty high up at that stage, though. They were pretty significant. I don't think so. You know what? I'm not sure. The nuances of their comings and goings. And so it's a bit of a blur at this stage. What happened in December, I don't. I certainly had no sense from the moment I published the scheme until they made their announcement about the requisition meeting that was going to happen. It was a complete and total shock to me. I was appalled. I mean, when I heard the news, I actually thought it was a joke initially. You know, you have this sort of, you wake up and you think, really? This couldn't be happening. I really was appalled because it just did not make sense. And particularly as that letter was addressed to all 7 trusts, and it set out all these accusations about lack of engagement and not addressing shareholder needs, et cetera, et cetera, et cetera. I just thought this is absolute nonsense. So my reaction was to reach out to Paul and say, we need to speak. We need to talk. I just don't understand what's going on here. And he responded, say he would speak to me early this week. And I said, no, it's too late because we have to publish the circular. Under the rules, we've got to get it out. I need to speak to you before that. Because really my objective is to try and talk some sense into him, say, can we actually agree to stop this madness? Because for me to go and do this requisition meeting that you're asking for is going to cost money. I've just spent quite a lot of money putting the scheme together to reflect your wishes and frankly, address all shareholders' interests. And now you're asking me to start a whole new ball rolling, which is going to cost me money and time. And for what reason? It doesn't make sense. So we spoke at length, and he said that he was not happy with the private companies component and how we were handling it. And I said, Paul, I don't understand it. When we first started the process, the private companies was around 4.7, I think. We're now down to 2.6. We've sold one of the companies, Boston Metal, and one of them we've had a lot of problems with, Northvolt, so it's been written down. So between the jigs and the reels, we're down at 2.7% to NAV. We have worked tirelessly with Baillie Gifford and the potential liquidators to figure out what we're going to do with each of those private companies in the portfolio. There is a plan in place. And once that scheme is approved and we hand everything over to the liquidators, Baillie Gifford have agreed to work very closely with the liquidators at no cost to make sure those private companies get sold. Because we do not want to destroy shareholder value here. It's really important we do it properly. Tell me what you would do with those private companies. It's only better. I just don't understand. You're actually not making sense. And he just kept going on and on about the private companies. So I just felt it was very disingenuous, actually. And I said, what can I do to allow you to save face, to back out of the situation? Is it the 1% to NAV? Is that your beef? And he said, no, actually, we think that's well priced. We don't have a problem with the 1%. I said, what can I do? And so he said, we want to go ahead of the meeting. You can't stop the meeting. You know, the horse is bolted. The meeting has to go ahead. And I pleaded with him around the cost and why, and this is not the best for our shareholders, et cetera, et cetera. And basically, he thinks he can win the meeting. And I said, look, Paul, you are not going to win the meeting because the meeting is an ordinary resolution. It's 50-50. And I'm going to get my shareholders out and they will vote this down. And he said, no, I'm going to win. He was very confident. You know, he's just very confident. So I said, no, assuming I do win, because I know I will, what then? We're then at an impasse. This is crazy. Let's deal with it now. He said, if you win, then we'll talk. So he's rolling the dice. That's how I see it. It's quite simple. He's rolling the dice. He's banking on the fact that I have a 20% turnout normally, that on my register I have 40% retail shareholders, 35% of my register is with the platforms. And, you know, we all know how difficult it is to get individual shareholders, particularly through the platforms, to vote. And they don't vote because, frankly, I have been a shareholder of Foreign and Colonial since I was 23 years old, and I have never voted a share. So, you know, mea culpa, I know what it's like. I'm one of those annoying retail shareholders who never votes. But why don't we vote? It's because we take comfort in a very well-regulated environment and with independent boards who do a really good job. Generally, they do a really good job. We can trust them. We trust the thing is being looked after. And if there's a problem, we get to hear about it and we get to vote down on these corporate actions normally. People can relax. And I'm afraid that is no longer the case with people like Saba coming into our market. So I feel passionately that people need to vote on this, because if they don't vote, it's tacit approval for Saba to take control of their company.
Right. And so you now think, from obviously based on what they've said in that letter when they were requisitioning 7 trusts, that their agenda actually is they didn't want a cash exit. It appears that they want to take control of the assets. That's what they want to do.
That's how it appears to me. And I said to him, I said, I'm an independent chair, so I have to do what's best for my shareholders. So I have to consider your offer right now to remove me and my colleagues, all of whom are independent, by the way, and to put yourself and your nominee on the board, and then to do what you're suggesting, which is that you're going to potentially appoint yourselves to manage this fund, and potentially, along the lines of this ETF. He mentioned the ETF, which is a similar strategy apparently to what they would propose for Keystone. So, in all honesty, I have to consider that as maybe it is a credible alternative for my shareholders. But I have no information. You're not giving me any detail. I have no real track record that I can stress test. I don't know who's behind it. I need a prospectus. I need a decent document that helps me really understand, is this the best thing for my shareholders? You're not giving that to me. So I can't, in all honesty, take you seriously. And as an investment trust director, I've done this a few times where we've either gone out to do a beauty parade and we either change our strategy, or we say we want to stay in this market, but we're looking for other managers to do the similar strategy. And it's a fantastic opportunity because you get to meet a lot of really good management teams, and you get to pitch them against each other, and then you get to negotiate on the price and negotiate on, the structure. And it's a great opportunity for putting something together for shareholders, or shareholders an opportunity to look at an IPO opportunity. You put a prospectus out, it's fully diligenced, it's fully transparent, and it's got a lot of detail in it. You get to read it, and then you get to decide whether you want to invest. Saba is not doing either of those two things. They are just coming in the back door with a minority stake in my company. They want to take control of it and then do whatever they want with it. And I just think it's outrageous. That's why when I woke up before Christmas to their letter, I was appalled. It's just appalling.
So, in your view, what should they have done?
Well, I think if Saba believe that they have got a strategy that is very compelling and which my shareholders and other shareholders would actually welcome, then set out their stall and do what most people do, which is put together a prospectus, get your advisors, have your legal due diligence on it, allow people to stress test it, and hit the road. Go raise your money. That's one way of doing it. Or pitch to a board and say, we think we can do a much better job than your manager's doing right now. And this is why we think. That happens quite regularly. People do approach. And on the back of that, boards will move. They will move a company to a different strategy because they realize this other manager will do a much better job. It's something that they could easily do if they believe that passionately in what their capabilities are and their track record is.
Presumably, they will say, though, that that's what you did as a board. You changed the strategy and it didn't work out, essentially, for whatever reason.
As I've said already, we as a board were very, very anxious about the challenges that we were facing with the performance. There's no question. But we also understood why our timing was terrible. I mean, it literally was terrible. That's life, okay? You make these mistakes. I don't think any of us on the board regret the decision to move when we did, because we were very convinced by what we did at the time. But we knew one of the risks was this rotation. And guess what? It came the following week. So, it was very, very unlucky. But always I'm amazed when you talk to investors about their patience, and they understand these things will come good. It takes time. You just have to be patient. But not everybody's patient. And particularly when the company is small and there's a lack of liquidity, then you, particularly with the wealth managers, you have a problem. So we recognized we needed to address that. So for those who were patient but wanted some certainty, we put the continuation vote in place. For others, we said, okay, we'll put a buyback strategy in place because that does help as best we can with the discount. At least we're trying to manage it. And eventually we realised, particularly with Saba's intervention, they said, we just want cash back. And we went around to other shareholders and said, yeah, I think cash back is not a bad idea. Some of us will take cash and others will roll into the more liquid fund. Liquidity is a real problem. And my liquidity was shot to pieces because I was buying back my shares and Saba were mopping up all the shares. They were buying every share that was moving.
So, I mean, the question is, I guess any third-party observer might say about this, do you think that the issues you've been wrestling with are specific to your trust, or are they specific to the investment trust sector as a whole? In other words, have we discovered a flaw in the investment trust structure, if you like, which is designed to attract patient capital, long-term capital, with independent supervision? or that model, if you like, is that being put at risk by what's happened over the last 3 years when the liquidity has dried up and everything's gone to a big discount? A lot of things went to a big discount.
I think it's being put at risk when you have investors who don't have that patience and don't actually understand or buy into the strategy. So when you have investors coming in who actually effectively are exploiting a loophole, and that loophole is that you have a large percentage of retail shareholders sitting on those registers who are patient and who don't necessarily share the desire that some of the shorter term players do. You can then hijack a company with a minority stake and take control. And that is now what is happening. And I think the industry is going to have to respond to that. And now that this US hedge fund has come into our market and is doing what they're doing, I think we will have to respond to that. I think the fact that this minority shareholder is also trying to be the manager of the company is a real problem.
Yes, there's clearly a conflict there, that's for sure.
It's a massive conflict. And I, as a board, because I did it with Keystone, you do not need shareholder approval to make the move to the manager initially, to change manager. And I think that's probably something that should change. And they need to find a way around it. I think the regulations will need to change to reflect this flaw in our system.
Right, and this vote that they've requisitioned, they only need a 50% vote of those voting to win the day, right?
Yeah, so what he's gaming, and there's no question, you roll the dice, you own 29% of the company, you need 30% of the other shareholders to come out and vote. Well, last time around, 20% of my shareholders voted. So he's banking on the fact that my shareholders will not vote because they don't normally vote.
I mean, you're doing obviously all you can to get that message out. It features prominently in your announcements, and you're doing this podcast and I'm sure lots of other things as well. And you can talk directly to the larger shareholders. But do you think that the platforms have a greater responsibility than they have been demonstrating so far in terms of keeping people informed? I mean, for example, I don't know if you hold your shares through a platform, but have you been contacted by the platform?
No. The difficulty I have, in my case, I'm with Hargreaves Lansdown. And with Hargreaves Lansdown, you have to opt in to be informed by them. And I think they only inform you on corporate actions. So one of the problems with this requisition meeting is technically it's not a corporate action. So my scheme, which was published in early December, that gets notified, but I don't. Anyway, to be honest, it's quite confusing, but definitely people have to opt in. And apparently most of the Hargreaves Lansdown clients don't opt in. And when you opt in, they will then email you to say that something's in your inbox. You then have to log on. You can't go through the app. You have to go through the website and you have to log in and you have to go into your inbox and look for the list of meetings where you can vote and then you can do the voting. So it is efficient once you've got used to doing it. But if you've never voted, you've never bothered to vote and you haven't opted in, then it's more challenging to do it the first time round.
And also, you have to look at your account frequently in order to see that there is a message. That's what you're saying.
Yeah, well, they will email you if there's a new message coming in my case, because I've opted in. But if you haven't opted in, I don't think they will contact you. So one of the things I'm hoping the platforms will try and do is keep people better informed. But certainly the platforms can't vote on behalf of the shares. If people don't vote, they can't vote for them. So people need to take responsibility and vote their shares.
Now, I've heard one director of one of the trusts affected saying that perhaps it would be a good idea if, by default, shareholders who didn't vote were effectively given the proxy, as it were, went to the chair of the trust. But that has its dangers as well, doesn't it? I mean, that might solve this particular problem, but it would have its dangers as well, wouldn't it?
I can absolutely support that from my personal circumstances right now, but I think in principle I wouldn't be so comfortable. It is a worry. We just need to get people to realise they need to vote. And it's a bit of an uphill battle, I think.
Well, you said at the beginning you're going to win. So you're confident you're going to win.
This is what really annoys me about my conversation with Saba last week is I have hired advisors to help with this process. So we've hired proxy advisors, we've hired media advisors, we have to hire lawyers, we have to hire bankers. We've had to hire all these consultants and resources to help us do this properly and get the vote out. And in doing this, I'm spending shareholders' money. And all 7 of us presumably are doing the same thing. It is quite frustrating. Yeah, I'm very disappointed really that we've got to this. Particularly in my case, because I have my scheme published and have reflected what they asked me to do when we spoke last summer. And his insistence that he's not supporting my scheme because of the private companies is totally disingenuous. And therefore, yeah. If I'd realised what I know now, I should never have believed him. It's a pity.
So it's a wake-up call for the investment trust sector, that is for sure, whether the vote goes through or not. If you do win the vote, what are your options after that, though? What are you going to do then?
Well, if I win the vote, My last conversation with Saba was that we would then speak. I would hope that they would be able to revive my scheme, but that requires their support, because unless they sell down, they might sell immediately and go away and stop being a problem. But as long as they're over 25%, I need their support for the scheme. So if that is not forthcoming, which frankly is quite possible the way they've been behaving, as irrational as it would seem to me, then I would work with my advisors to come up with a way to return cash to our shareholders, which doesn't require a special resolution. And there are ways. And to be honest, I haven't done much work on that to date, because I don't want to be incurring cost unnecessarily, because I'm a half glass full girl. So I'm hoping that they will actually be willing to talk and we'll find a solution, sensible solution, without incurring a lot of cost after the
Right,
meeting.
because effectively they can block your scheme, but if they don't come up with an alternative, you're into a bit of a headbutting process, aren't you? But you're hoping it will be consensual, because they would be
I
on
hope
this.
it's consensual. I'd be very surprised if it's not consensual, because they claim to care about shareholders and et cetera, et cetera. I'd be very surprised. But if it were to come to that, there are ways that we can find a solution for our shareholders to return cash, which does not require their support, because they don't require a special resolution. It's not necessarily as efficient, but there are ways of doing it.
Okay, so that's good. But I guess from their point of view, that would mean that they won't be facing the risk that whatever happens, if you win the vote, that the share price will then fall, the discount will widen again, and you'll be back to a situation where they're actually not going to make as much money as they would do under your scheme.
I think, yeah, it feels pretty irrational to me. It really does.
But essentially, one way or another, unfortunately, Keystone Positive Change Limited has no longer got a long-term viable future.
And it's with a heavy heart, I agree, it doesn't. The good thing is that those investors, and there are many who really like the strategy. I mean, it's a global impact strategy, and we're investing in companies which are addressing the challenges the world is facing. They're the companies that are coming up with the solutions. So that's why we moved to this strategy in the first place. We feel very passionate about the future of the strategy, but it does require patience, and it does require people who are not short-term in their thinking. And so for those investors who really do support the strategy, we're offering them the open-ended fund, and it's much more liquid, it's much larger, and it mirrors the Keystone Investment Trust listed portfolio. So the only thing is they won't get the private companies.
Right. Just on a smaller technical point, you made the point when you first announced the change of management strategy, the share price did improve significantly. So in that sense, in the real world, the performance that this trust has delivered actually should be dated from the point you announced that scheme to whatever it might be. So there's so much you can do with numbers, aren't there? You can throw around statistics about how good the performance is.
In university, in my first year university, I did a statistics course, which I have to say I found quite challenging. The thing I came away with was never trust a number you read. Never trust it. Always look behind the numbers, because it's so easy to manipulate statistics. So I caution people when they're reading these claims and statements about stats, just be careful, because it is easy to get it wrong.
So final question then, Karen, is what do you think that those people who want to help you, obviously they need to get out and vote, but do you want to enlist them to get other people to come out and vote?
Yeah, I think I would like to see every golf course, coffee morning, school playground, everybody should be talking about whether they have shares in any of these investment trusts. And if they do, please vote your shares at these general meetings. I'm not telling you how to vote, just vote. That's the key thing. And at least then, you can stop them taking control of the company if that's what you wish to do.
Right. You're not going to be the first trust that has a vote, though. I'm not quite sure of the timetable, but there are others who are slightly...
There's one before me. Herald is before me. I think they're the week before. And I think we went out the same day as US Growth. And then, the last is Edinburgh Worldwide, because Saba messed up on their requisition. They had to redo it. So that's delayed that one by about a week or so.
So I guess you would be hoping that if one of the others get a good win or lose, either way, that may have some knock-on effect on...
The thing about the voting is, like in my case, my meeting's on the 3rd of February. You have to have your votes in by midday on the 30th of January. But actually, if you're going with Hargreaves or AJ Bell or one of these platforms, it's often up to 5 or even 6 working days. You have to submit your vote before the deadline. So I would encourage people to get their votes in before the 21st of January, for example, in the case of my fund. And US Growth will be the same. And then CQS is probably the next day. And then the Hugh Henderson funds is the next day. So we all need votes to be placed probably by the latest 23rd of January.
Very good. Okay, well, thank you for your time. It was very interesting to talk about this whole situation. And, well, we'll wait and see with interest what the outcome is. But thank you for sharing your thoughts.
No, I really appreciate the opportunity to talk to you. And as you said, if you have Saba speaking to you next week, then invite us back afterwards, all of us together, and we can have a good discussion. I'd say it'd be quite rich.
Yes, I'm not sure that I would have the bandwidth to keep everybody under control, but we'll see about that. Anyway, there may be another opportunity. Let's see how this all pans out, and we'll take it from there. But thank you so much for sharing your thoughts with us today.
It's a pleasure. Thank you.
So that was Karen Brade, the chair of Keystone Positive Change Investment Trust, one of the targets of requisition votes from Saba Capital. We'll have more conversation about this in the next few editions of the podcast, that's for sure. Coming up after the break, I shall be talking about this Saba development with Ben Conway, as I said earlier, the head of fund management and chief investment officer at Hawksmoor Investment Management. So please hold on for that. You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results, and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favorite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. Also this week, I caught up again with Ben Conway, who is head of fund management and chief investment officer at Hawksmoor Fund Management. So, Ben, first of all, we know that Saba Capital has been around for a couple of years, but this has all now come to a head. Why do you think it's come to a head in this way? And what's your interpretation of how things have developed with these requisition votes just before Christmas from Saba Capital?
Well, thanks very much for having me, Jonathan. It's a pleasure to be on again. I mean, when you say in this way, are you referring specifically to the nature of Saba's approach and the way they built up their stakes and then issued requisitions? Is that what you mean by that?
Yes. I mean, in other words, how come this has ended with them requisitioning a votes to try and throw the board out, when from the beginning we thought they were just trying to get some cash realization by bringing discounts in?
The simple answer is I don't know. And to really understand Saba's motives, you'll have to ask them. And to be blunt, I mean, my main concern here, or concern is maybe not quite the right word, is not why they're doing it, or not rather their motive for doing it, but why have they been able to do it? And I think they are taking advantage of an opportunity that exists in this sector that didn't necessarily have to emerge, i.e., the question I would be asking rhetorically is, could boards have done more to prevent these opportunities emerging? And Saba are only taking advantage of something that is there, and they're doing nothing illegal, nothing that's against regulations. And I think that's the really apposite question to be asking here, with apologies for I haven't answered your question.
Not at all. I mean, there's so many angles to this particular development that we may be able to explore them all, I don't know, in the next few minutes. So the circumstances are that the reason they've been able to do this is because they've been able to build up a significant shareholding, 29% in some cases, because discounts have gone so wide, reflecting a lack of buyers and an imbalance between buyers and sellers. I mean, that's essentially what's
Correct.
happened. So your point is that if boards have been presumably more active or communicated better or some other things they might have done, they would not have had the opportunity to build up such a significant stake anyway at these very big discounts.
Exactly right. And you've just summarized it very, very accurately. And the share prices in the market, to be somewhat facile, is a function of supply and demand for those shares. And then the discounts or premium emerge depending on supply and demand for shares relative to net asset values. Why discounts have emerged is because there's been, as you just said, an imbalance of supply and demand. So we know that, for example, the consolidation of wealth managers have caused some selling, an increase of supply of shares in investment trusts. So the challenge that I and we at Hawksmoor have been giving to boards, especially now because discounts have been persistent for quite some time and enabled Saba to come in, is to identify a new source of demand. What constituency of investors is going to replace the demand that was previously there from wealth managers? And how are you going to encourage that into the sector? And so, again, I think that when these sorts of things happen, rather than rail against the fact that there's an actor that you don't like taking advantage of something. I think everybody in the industry needs to self-reflect and think upon, if you don't like what's happening, what could one have done to stop it happening? And I don't just mean boards, I mean investment managers, I mean brokers, and I mean investors like us as well.
Okay, so we'll come back to that issue of what they could have done. But before we do that, perhaps we could just raise this issue that the reason why, that's what many people believe, the reason why Saba is able to potentially take control of these trusts despite only having a minority shareholding is because a lot of investors do not vote on requisitioned meetings like this. And the boards of the trusts that have been requisitioned are going to have to do very well to get the private investor in particular, to get them to come out and vote, whether that's directly or through a platform. And that's not something which historically they do. So do you think there's also a structural issue, before we get on to what the boards have done, a structural issue about the fact that Saba can just win a vote with 50% of the turnout, even though they do not have the support of the whole shareholder base? Is that a structural flaw in the way that investment trusts have to operate?
No, I feel quite strongly about this, and I think that people have been making too much of this point. Firstly, retail investors can vote. And the AIC have been fantastic, actually. If you go to the AIC website, they've got a table which very clearly shows, if you hold a share of an investment trust on a particular platform, it shows you how on each platform, if you're a retail investor, how you can vote. In some cases, it's really easy. In some cases, it's a little bit less easy, but nonetheless, it's not that difficult. So the first thing is that retail investors can vote. The second point is, well, why don't they? Why is there this apathy? And there has been this huge effort on the part of some of the boards and investment managers of trusts that have been attacked by Saba to mobilize and enfranchise that vote. Well, my question is, well, why wasn't that being done before? So if you know that you've got a large proportion of your register that is retail, and if you have had votes previously where the turnout's low, and the reason why the turnout's low is because the retail investor base aren't voting, why wasn't that concerning to you before? Where were all these campaigns to get the retail vote mobilized and voting? Why does it take this to get people to really start to try? And the second thing I would just say tangentially is when you look at turnout rates of prior votes, it's not always just because retail aren't voting. There are other constituents of investors that have been slightly poor at voting as well. So I think it's beholden on investment managers, advisors of trusts and the boards themselves to, if you know that you've got retail on your register or anyone else for that matter, these people should be being encouraged to vote and being enfranchised, being directed and told how they can vote. And lastly, if you then know that having told these people this is how to vote and they still don't do it, well, you then got to consider that that is a risk that you face with having these people on your register.
That's certainly true. And of course, it's also true that in some cases, fund management houses that actually had direct saving schemes and so on, they could communicate directly with their shareholders, but they outsourced that effectively to the platforms to take up the thing. So that has perhaps turned out to be something of an own goal. They saved some money by doing that, but they perhaps lost contact with their shareholder base in that way. Will you agree with that?
Yeah, absolutely. And I really strongly believe that shareholders have a duty. You have a responsibility. If you're an owner of a share, then one share is one vote. And there's a really strong principle of shareholder democracy in our society, and it's a privilege. And if one wants good outcomes as a shareholder, then one must vote and if possible, and if you've got the time and resources to engage. And I think that tangentially, it's up to organizations like Hawksmoor to highlight the fact that, well, we're not exiting the investment trust arena. We're not so large that we have to sell these things. And we do vote and we do engage. And it's up to organizations like us and others to highlight the advantages. And if you as an investor don't have the time and resources to be doing the investment yourself, you should be perhaps thinking about allocating to wealth managers who do that, as opposed to much larger firms who are having to exit and can't hold the shares, or indeed wealth managers who perhaps aren't engaging and voting. But back to the point, I think it is an own goal. Yes, if you are aware of and have previously encouraged shareholders onto your register who can't or find it difficult to vote, one has to bear the consequences of that event.
There may be sort of a structural impediment, or there may be some questions about the way that platforms do actually enable private shareholders to vote. So it's not quite as straightforward as it perhaps it could be. And you have to opt in. For example, I believe on Hargreaves Lansdown, you have to opt in before you'll actually be notified that there is a big vote coming up and so on. maybe there's something more that the platforms could do, but you could argue, I suppose, why should they?
Well, their consumer duty, there's an angle there. If you're going to host these sorts of clients and you're going to hold them in nominee accounts in your platforms, then again, rhetorical question, under consumer duty, is there perhaps potentially an obligation for these types of intermediaries to make it easier and really show retail investors how they can vote? And if they're not voting, see why they're not.
I mean, for example, maybe you get messages and hopefully an email as well from your platform if something significant is coming up. But we always go on about how investment trusts are long-term savings vehicles, patient capital and so on. And not everybody is either capable or advised to look at their portfolio every few weeks or every month or something in order to see what's going on. So in the real world, it is the case that I think boards do have a problem at the moment. And your point, I think, is very valid, that maybe they should have thought of this before. Therefore, the implication of what you're saying is that if bad things arise as a consequence of this system and the fact that retail investors don't vote, your argument would be that basically that's their lookout. And certainly the fund manager companies look out and boards look out.
Yeah, that's right. That it becomes a problem, doesn't it, in situations like this? So hindsight's wonderful, but I think that when discounts are persistent and there is a weakness in your register, or inverted commas a weakness, that your turnout is persistently low because of the nature of the investor that you've got there, then you have to say, right, hang on a minute, we've got this discount, there is an Achilles heel here, we are open to attack. What can we do to prevent that? Well, we can try and find a new constituency of investor. I happen to think, for what it's worth, you say, well, Ben, which ones are they if wealth managers are exiting? Well, I think DC pension funds should be courted with great alacrity, particularly given the strong advantages of the investment company structure versus, say, for example, the LTAF. That we're going off on a massive tangent. But all I'm saying is that there's been a diminishment of demand from one community, which has really contributed to this discount emerging. And so one has to find ways of attracting new investors rather than just sit passively back. And I don't think it's Irene, that's putting it too strongly, but whenever I speak to both investment managers and boards, they're always really, really keen to attract retail investors. They're sort of the great white hope of this thing. But we're now seeing the downside of having the retail investor on your register, unless you can really enfranchise them and encourage them to engage and vote.
I did say if bad things happen, but of course that is just begging the question, which I've acknowledged, that whether or not if Saba were to win some of these votes, in other words, they were to get more than 50% of those who did vote, and they now then go on and appoint 2 directors of their own, nominated directors, and then potentially change the strategy to something completely different. Is that necessarily a bad outcome, in the sense that, who's to say that that is going to be a worse outcome than the one that you would have by voting with the board, especially because Saba's involvement has led to a significant narrowing of discounts in the case of most of the trust in which it's invested. So it's not quite as black and white as that, is it?
Yeah, brilliant point. That is a subjective judgment. We're not shareholders in any of these trusts in the funds that I run, and I'm not going to start saying which ones I think is a good or bad outcome, or try to lead people in terms of how they think they should be voting. But your point is really, really valid, and that is every single shareholder should be making their own judgment over, we're using the information to hand about whether this is a good or a bad thing for them. But to further develop your point, I think it's incumbent on every single board, and this is not a generalization to each of the 7 trusts, because they've all got their own individual circumstances. Some already had addressed this issue, of course, and some hadn't, but they should be saying, if you do not vote for the Saba proposals, this is what we will do. And this is the things that we will do to improve outcomes for shareholders versus how it was before Saba got involved. But I completely agree with the sentiment in your question.
Yes, I'm not trying to pass judgment in any way. I'm just saying that it's not necessarily a disaster if, for example, you are offered a cash exit close to NAV, which is what Sabas say they want, or at least said that publicly, until they recently changed their tune a little bit and said they now want to take control of the board with an uncertain destination after that. You can't necessarily say that's a bad outcome.
Can I just add, Jonathan, as well, is that the nature of shareholders at the time that these things happen is so important. And this is what happens when you have persistent discounts, is the register can turn over, and the register can turn over, and the nature of your holders can change. And so the type of shareholders that you then have at a time like this can be really existential for the trust, because you could have some investors who have taken advantage of these discounts I'm not just talking about Saba here, I'm talking about shorter term players who are then very happy to see the trust die out or go into Saba's new form of it, because they can take advantage of the exit close to NAV and make that short-term uplift versus the price they paid.
Absolutely. And as you've also made the point, I mean, we're not going to talk about individual cases. The 7 trusts that have been requisitioned so far, Saba also owns stakes in several other trusts as well, but not necessarily such significant holdings. There are some very different segments. So, for example, I can mention the case of Keystone Positive Change, where they've already announced a plan to offer investors either a rollover or a cash exit near to NAV. So it's not clear what Saba would be offering that is any better than that. But you contrast that with something like Herald, which has been around for a long time, has quite a significant holding of unlisted investments, and also has a lot of investors who are sitting on unrealized capital gains over long periods of time, where a rollover vehicle, at the very least, would be of value to them. So it is different from case to case, as you say. In other cases where perhaps the boards have not done enough to address the discount so far, and they are going to be more vulnerable, I think, to losing these votes. So it is a complicated picture. Are you going so far as to say that whatever the outcome of these votes that are coming up, that Saba's involvement has highlighted a problem for the investment trust sector and is therefore a significant wake-up call?
Yeah, exactly right. It depends how you define what a problem is. But yeah, I mean, I think this is, from 10,000 feet up in the air, this is undoubtedly positive for the sector, because it's going to encourage other boards that may have similar attributes to one of these 7 that are under inverted commas attack, because I don't think it's quite the right word for it, but it will encourage other boards to say, goodness me, we don't want to be the next target. So it will encourage those boards to do something about a discount, if there is a discount there that's both wide and persistent. Has to be a good thing.
Absolutely. So if nothing else, it's going to accelerate the pace of change, if you like, that we've already seen. We have seen quite a lot of consolidation already, and boards taking steps to address the discount quite dramatically in some cases. You think of trusts like Smiths and so on, which have actually bought back, I think, something approaching about a third of their share capital in the last 2-3 years, and others who maybe have bought back 4 or 5%, that sort of thing. So perhaps more decisive action is one of the consequences. Do you think that there's going to be more consolidation as a result of this? In other words, we know we've seen a lot so far, but there's going to be more, is there, in your view?
Well, I think there's going to be more action on the parts of boards to introduce measures that will have an increased probability of closing discounts. And at the margin, it should lead to pressure to improve capital allocation policies and corporate governance. Now, what form that will take, it could be consolidation, it could be buybacks and shrinkage, I don't know. And I'm sort of ambivalent about, depends on the sector and depends on the trust about which route it takes. But I think my point is that for this sector to continue to thrive, if all of that process means a little bit of shrinkage, so that we're left with a sort of, in inverted commas, healthier, narrower discount, slightly higher levels of corporate governance, number of trusts, then that's one step back to go a few steps forward. And it's just part of the continuing evolution of the sector. I think that the sector is, 155 years old, and there is some examples of fantastic governance. The corporate governance code is brilliant, and I think that the average levels of governance, for example, in the closed-ended space in the UK, are superior to those that are found elsewhere, particularly the US. But there is clearly room for improvement, and we've had some external structural headwinds that put us in this situation. We've already talked about them today, one of the major one being wealth management consolidation, and the other one we've previously spoken about, for example, is on the cost disclosure point. But the sector just, it has to react to that. It doesn't mean it's going to completely die out, and nor do I think we should be particularly gnashing our teeth about a bit of shrinkage. The sector will prove itself, and this is just one of those episodes that it has to go through, that's a necessity to improve the health of it.
It's notable there that in the case of the trust that Saba Capital has been going after, if that's the right phrase, they are mostly own listed equities. They're not directly or as badly affected by cost disclosure issues as many of the alternative asset investment trusts are. So do you really think that cost disclosure is an issue here for these kind of trusts?
It's not quite as big an issue, but yes, I think it is. Yeah. But no, you're right. I think the cost disclosure issue is more important, but the cost disclosure issue is important for the whole sector because, again, I'm going to repeat myself from previous podcasts, is that if you're giving people wrongful information, if you're telling that even with an equity trust that this sum of money is being deducted from your share price and it's just wrong. And then you're a retail investor, you go into a platform and it tells you in your cost illustrations that hundreds of basis points of cost are being deducted from your share price when it's just not. It's going to put you off. And I think also in wealth management portfolios, it's not just the fact that it's the removal of an inverted commas an advantage. I think because of, even with an equity investment trust, okay, let's park the liquidity issues to one side for a minute and the fact that wealth managers have got bigger and bigger. So even equity investment trusts are more difficult for them to own. Let's just park that for a second. If you've got two different vehicles, one is an investment trust on a discount that is discounting the costs of running the vehicle, but then it doesn't contribute to that portfolio's OCF. That's, in inverted commas, a better thing versus an open-ended fund where it is contributing to the OCF. And in the sort of post-consumer duty world, commercially, it's a really good thing to keep your overall portfolio costs down. Then, investing in an investment trust should be a better thing. But with the cost disclosure issue, it no longer was. So you would always therefore go towards the open-ended side of things because there's much more liquidity there, if I've made myself clear there. So it is an issue for equity, not quite as much as it is though for the alts.
Yes, we're not going to talk about the cost disclosure with you at this point because we've covered a lot in the past, but there is still conversations to be had about what's happening there, but we're holding them over for another time. So, Chris, I've asked you, though, wearing your fund manager hat, do you not regret that you don't own some of these trusts that have come in from a discount of 25, 30% to close to par now because of what Saba's been doing? Is that a kind of oversight on your part? Maybe you've missed a trick here.
Yes, maybe. Yeah, if I've got to speak with the appropriate humility, yeah, absolutely. But when we invest, though, we're not trying to second guess what other types of investors are going to do. So I don't think it's a particularly strong way to invest to sort of buy something that's a discount and then cross your fingers and hope it becomes a target for a nature of investor like Saba. But over time, I think with the principles that we operate under, which is trying to find good investments at discounted prices, then eventually some of the things that you own will become a target if your assessment of the value is correct. But what we don't want to be doing is be in the business of investing in trusts. What we don't like doing is invest in trusts with a really subpar track record, because what if we don't happen to have an activist come along and, in inverted commas, rescue us and change the manager or give us a takeout at NAV and we make a nice little uplift? What if that doesn't happen? Then we're still stuck in a trust with a manager that we don't entirely believe in. But yeah, point well made, Jonathan.
Finally, then, Ben, on this particular topic of the Saba Capital, which is going to be around for another few weeks for sure, can I ask you who's going to win these votes?
Oh, I don't know. I really don't know. I hope that whatever happens, corporate governance standards are upheld, that shareholder democracy works, and that the efforts of both boards and managers to get the vote out work. It'd be really nice if turnouts are as close to 100% as possible, so that whatever happens, there can be no accusations of, either side only won because the turnout was so low. I really hope that happens. And I also look forward to, as a result of what's going on here, seeing corporate governance and capital allocation policies improve across the board. I think that just a final thing I'd like to say, it's sort of in defense of Saba, is that it's not clear in their requisition notices, but if you read their now infamous Mind the Gap letter, and I'm referring here to some of the accusations that's been leveled at them in terms of subpar corporate governance, though they could be a lot clearer in their requisition notices, I think it does say that they promise to bring on further independent directors in time. And I think that it's not necessarily the case. There's a big, bad, evil American investor that's going to severely dilute standards of corporate governance. Not necessarily the case. So I hope this episode can be conducted in a way that leaves the sector in a better place and average levels of corporate governance higher. And also, just to say, we're massive backers of the sector. There's some wonderful, wonderful trusts here with really good long-term track records, and also with some boards who I really like. For example, I can say, I'm not going to embarrass people, but there's some boards here that have been really, really helpful and really care about the sector. And I can evidence that with their help and support in the cost disclosure campaign, for example. So it would be a real shame if the boards of some of those trusts are no longer existent. But that being said, we do operate and live in a shareholder capitalist democracy, and that is a good thing. And I suppose it will be sad if that happens, but that's the world we live in. And I think we should continue to live in that sort of world.
Well, on that note, that's very helpful. Thank you so much, Ben, for your time, as always. And we will come back and talk about cost disclosure with perhaps a little heavy heart in some sense, because it's always complicated and rather difficult. But thank you for your comments on this, and we'll look forward to speaking again soon.
Yeah, absolute pleasure. Thanks, Jonathan.
That was Ben Conway, the head of fund management and chief investment officer at Hawksmoor Fund Management.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.